In today's video, we're going to talk about a trading edge that exists in the market that very few people are aware of, and as far as I know, no one else teaches. I'm Steven Spencer. I'm a partner at SMB Capital. We're a proprietary trading firm in New York City where we trade stocks, futures, and options. Good short-term traders spend time looking for stocks that have a strong catalyst. The reason is quite simple. A strong catalyst will cause a lot of people to either buy or sell a stock. When that happens, traders can book profits from the increased volatility, but also control risk as liquidity is higher. Allow me to explain. Catalyst is a piece of news that will cause very large market participants to either buy or sell a stock. When I say large, I mean firms with hundreds of millions or billions of dollars in the market. The essence of all short-term trading is attempting to identify what these participants are going to do and how it may impact price. If you can do this, you can develop a trading strategy with a great risk-reward. And the only way to succeed as a trader is to make hundreds of great risk-reward trades. Then over time, you'll become the casino. That is your edge. Part of our trader's morning routine is scanning for these catalysts. The tool we use is called the SMB scanner. It identifies the stocks that have catalysts and have already begun to trade before the market officially opens for business. We develop a short list of stocks to focus on and then outline a plan of attack. If you want to find out more about how we identify these stocks and develop our plan of attack, check out the 2 free-hour workshop at tradingworkshop.com. I spend 30 minutes teaching this process. Today's example is Home Depot. They reported earnings for Q4 and something stood out that was unusual. Despite reporting strong revenue, their earnings per shares were below estimates. For those of you who aren't familiar with income statements, this is a potential red flag. For every dollar of revenue a company receives, a certain percentage covers their costs and a certain percentage is profit. For example, a business like Home Depot may make a $10 profit for every $100 in revenue. If their report is $100 of revenue and only $5 of profit, this can make investors very nervous. Now to the technicals. Let's take a look at our AM game plan notes. Each one of these levels are based on our prior support resistance areas established by buyers and sellers. And with a short bias, we will look for the stock to trade down to the support levels in the game plan sheet. If the stock shows momentum below our support levels, then we will stay short for a swing trade. Now, here's the part that no one will teach you about this setup. Home Depot released earnings before the market opened, and then they held a conference call before the market opened. There is not enough time between the earnings release and the trading day for many large funds to do their analysis and decide whether to sell some or all of their positions. So what may happen quite often is on the second day, once those large funds have done their analysis, met with the portfolio managers, they may decide to sell their positions, or at least some of their positions, because of this huge red flag that we saw. And that's something that you can take advantage of. And so we'll go through, we'll take a look at the longer term chart. We'll look at when they reported 2 quarters ago, last quarter and this quarter, see how things set up technically, because ultimately, even though we have this red flag in the earnings report, and we know that the stock, there's a good chance that some large institutions will sell, we want to understand what the important price levels are to give us a further edge rather than blindly shorting the stock. First chart we're looking at here is a daily chart, and what we can see is that Home Depot actually went up quite a bit last year. It traded up from about $180 to $280 a share, and since that time has had 2 earnings releases just before the most recent one a few days ago. The first time they reported, you can see there wasn't a lot of price action towards the upper part of this consolidation we're looking at. The next time they reported, it was at the top of the range, sold off pretty hard. That's something we want to keep in mind because we know that stocks tend to have a muscle memory. They will repeat themselves in terms of patterns, and if you have a similar setup where a stock gaps up again and you see a red flag type of news, that perhaps you can have a wide range day and it can sell off pretty hard. The other thing we wanted to make an important note of here is this is a very large trading range, and when the earnings report comes out, it is still inside of that large trading range. And if it's showing weakness, we basically that bottom of the range is a target. It's basically the analogy I was going to say is it's like something with a target. It's on its back. The target for when the stock gaps down is that bottom blue line there where it's supported over the last, I don't know, 7 or 8 months or so, going all the way back to August of 2020. And so if we have a decent amount of room between that support and where it's opening on day one, we can trade it on the short side. And remember, this video is about being short on day two. This doesn't mean when I see a red flag and the margins don't look good that I'm not going to short it on day one, but I'm very mindful that I want to be shorted on day two if there's going to be large funds who are then going to basically start to hit the bids. And the third thing is, if it then closes below the bottom of this consolidation area, I am going to just stick with it on the short side, because we know that anytime you have a long period of consolidation, then a stock moves outside of that range, it can attract more sellers or buyers depending on which way it breaks. On the upside, obviously, it'll attract more buyers. You can have another huge move to the upside. And if it breaks to the downside, it'll attract more sellers, people who are technically inclined, and then it adds more fuel to the fire, and it can be the beginning of a larger downtrend. And we'll see how this unfolds over the next couple of weeks. So here's the intraday chart. So this is day one, and what you can see is the top blue line is what we put on the morning game plan sheet. You saw inflection. It's a common question we get. What is this inflection, Steve? What do you mean by inflection? Inflection is a price that right when the market opens on day one, if the stock is below that level, I will look for it to trade down to the support levels. And if I have a short bias, in this case I did because of the issue with the margins, that red flag, if it opens just below the inflection, I will look to trade it on the short side, and it very quickly trades down to S2, take profits, and then see what happens from there. Now in this case, it actually traded all the way down below S3. That means that there's strong downside momentum. So this, in a sense, despite the fact that many funds are not going to do anything till day two, day three, not on day one, there's people selling this when it gaps lower. Conference call, nothing was said in the conference call to make anyone feel any better. So the market opens and there's some selling. And the momentum is to the downside. And we know the momentum is to the downside because it's taken all of the 3 support levels we've identified in the morning meeting. And again, as I said, if you want to understand how we develop support levels, how we pick the stocks, just go to tradingworkshop.com. This is all covered in the 2-hour workshop. So after it goes below S3 and starts to turn back to the upside, the most common thing that I'll do is, well, the first thing I'll do is I'll look to see if it fails at S2. If it gets above S2, then I will look to short it into S1. But it's very unusual for a stock to have that much downside momentum in the morning, retrace all the way back up to S1, and not be a pretty good short entry. And so in this case, I've circled that. That's the first spot I circled, is it retraces back up to S1. And the great thing about it is it actually moves sideways. As traders, what we like is sideways action, which we call consolidation, because it's the easiest way for us to control our risk. So anytime something retraces all the way back up to S1 and then starts to move sideways, that allows you to put on a large position. The reason it allows you to put on a large position is it's very easy to identify where to put your stop. Your stop is going to be above, about 15% of an ATR above that consolidation range that we've identified. And I'm talking about an intraday trading perspective. If you shorted this right on the open for a swing trade and you're just going to be shorted as long as it closes below the inflection for the day, that's not what we're talking about right now. We're talking about a retracement trade, intraday, short entry at S1. When it comes back down to S2, maybe cover a quarter position. If it comes back down to S3, cover another quarter, and then you would have half the position left as a swing. In this case, it didn't do that. It rolled over back below S2, started to retrace back up to S1, and they're still selling it there. Sell it again. Short it again. S1, can't hold above it, short it, and we'll see what happens. Starts to roll over, but it actually goes up. That's unfortunate, right? But this is trading. We want to make this trade every time we see this setup where it goes down, momentum on the open, negative piece of news, retraces back up, they're selling at the key level, short it. Comes back up to the key level again, short it again. In this case, it actually moved higher. From an intraday perspective, you're going to have to cover most of that position. If you were thinking about holding it, giving it some more room, you could hold the last 25% of that position until it takes out the morning high, just so you have some on day two. Because remember, this video is about day two. So let's go over to the right side of that chart there. That's day two. Remember what we talked about. We saw some negative news, big funds, they're going to The analyst's going to look at it. They're going to take notes on it during the conference call. They're going to discuss it in their morning meeting the next morning before the market opens. And they'll say, they didn't say anything good on the conference call. Margins were weak, even though the revenues were good. The stock ran up $100 in the last 8 months or last year. We don't see that much more upside if their margins are deteriorating despite sales being strong. And the next day they're going to come in and hit the bids. And the reason why we know that funds on day 2 were hitting the bids, if you look at what the market did on this particular day on day 2, the market basically was extremely strong and went up, I think, a couple of percent. And so if you see a stock that on day 2 is going down and the market's going up, that you know institutions are dumping this stock. And so when you come in, same spot that we were looking to short it on the retracement on day 1 is where you want to short it on day 2, and that's right below S1. In summary, company reports before the market opens, conference call happens, large fund is not going to be able to put together their notes, the analyst who covers the stock for the fund, until day 1 is over. So we have an edge coming into day 2. We want to use our levels from day 1 to inform our trade. And in this case, we knew where it was sold on day 1 in the area that was circled twice on day 1. When we come in the next morning, if it drops below that level, get short with a stop above the morning high. And if it then continues lower and consolidates below S3, we can look to add to the position. And in this case, it just went straight down so strongly, there really was no place ever to add to the position. But if it had gone down to S3, moved sideways for 30 minutes or more, we can add to the position with a tight stop, the same way where we entered at S1 on day 1 and on the open on day 2. And that's how you would attack this trade. So when you see it, when a stock reports in the pre-market, you notice something there, unusual strong, unusual weak. On day 2, use the level from day 1 and jump in with confidence as long as the first move is in the direction of your bias.